Hello, 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 and welcome to episode 176 of the Mo Money Podcast. I'm your host, Jessica Morehouse, and I'm so excited to have you with me for another episode of the show. Got a great episode for you. And in case you're wondering why my voice is so raspy, well, man, I just got myself a cold now, didn't I? I have been working pretty damn hard the past couple months, and I think it just all kind of came to a head, and I got a cold on my way to Ottawa this weekend because I had a speaking engagement at Carleton University, and oh man, I had a great time in Ottawa. It was amazing. I also was lucky enough and able to do kind of an unofficial meetup with some of my wonderful podcast listeners. I posted a photo on my Instagram if you want to check it out. Also, of course, there to speak to a wonderful group of students at Carleton University about post-grad game plan, what you should know about money after you graduate, things that I wish I knew, mistakes I don't want to make other people to make. So it was an amazing time in Ottawa, but I feel like I didn't really get to see too much of Ottawa because when I wasn't either like at that meetup or doing my speaking gig, I was just in bed watching like Harry Potter or something. I just, could not get out of bed. And of course, luck would have it. Right after my speaking thing at Carleton, me and my husband got back into our car. We stayed a couple nights in Ottawa, but that night we just wanted to head back home. And so we took the long 4-hour drive back to Toronto and completely lost my voice. So it was the weirdest experience to I don't know. I guess I talk a lot, probably, because I wanted to speak so many times in the car and I couldn't because there was nothing. It just hurt too bad. And there was nothing that would come out. Being silent for 4 hours is not as easy as I thought it would be. So anyways, so that's me. That's what I've been up to. But luckily, I did not have a cold when I recorded this interview with my next guest, Som Seif. He is the founder and CEO of Purpose Investments. And if you're like me, you probably, fly Air Canada, you'll always see his ads, his wonderful Purpose Investment ads. So I definitely kind of fangirled a little bit. But he is basically just like the perfect person to have on the show to really get into the nitty gritty to talk about investing. And I've been getting a lot of feedback from you listeners to get more people on the show to talk investing. So I know you're going to love this episode. But before I get to this episode, just a few words from this episode's sponsor. This episode of the Mo Money Podcast is supported by CoPower Green Bonds. Looking for a sustainable way to invest in fixed income without sacrificing high returns? Then CoPower Green Bonds may be the investment solution you're looking for. Investing in clean energy projects throughout Canada is a great way to put your money to work while making a measurable impact on the environment. Let me break down how this works for you. You buy CoPower Green Bonds, and that money is used to fund clean energy projects and energy efficiency projects that reduce carbon and generate steady revenues. Revenues that are used to pay Canadian investors like you. How much do you earn on these bonds, you may be wondering? For a 4-year bond, you'll earn 4% annually, and for a 6-year bond, you'll earn 5% annually. The only thing is, there's a limited supply of green bonds left. If you're interested in investing this year, don't miss out. To learn more, visit greenbonds.ca. Once again, that's greenbonds.ca. Thank you, Som, for joining me on the Mo Money Podcast. I'm excited to chat with you.
Great to be here.
I don't know if you know this, but I don't know if we actually met, but I remember the first time I saw you speak, and I think it was about investing, I think it was back in 2013. You spoke at one of the first Canadian personal finance conferences. That was a long time ago.
It's one of my favorite things to do. I get busy with a lot of things in my life, but being out and talking to investors and speaking about both the principles of bias and investing, but also individually just thinking about, the things that we should be doing right and focusing on. It's just one of my favorite things. And so I always tell the team here that if I could kind of restructure my schedule and have other people run everything and I could just be out talking to clients and to the market, it would be one of my favorite things and the best jobs in the world. So.
Yeah, definitely. Well, I feel like, at that point, I really had no idea about anything about investing. So I'm like, wow, that guy sounds smart. Fast forward a couple of years, now I can actually have a conversation with you about investing. So I'm looking forward to that.
I'm glad that helped you with some foundational work.
Yes, it definitely gave me some homework. I'm like, I need to look into whatever the hell that guy said.
Also loving your Air Canada ads. Every time I'm on a flight, I see your ads.
It's funny. You get branded a fair amount on this one. It's very effective advertising.
It
In a
is.
positive way. But I now go around and everyone calls me the Air Canada guy, and so I have to sort of start to explain that I'm just the actor in the advertising, and they kind of let me run this company thereafter. So,
but yeah, now I kind of just every time I see your ads, I associate you with Air Canada, which I love. I don't know.
Well,
it's a good thing.
I'm the Air Canada guy from you.
So for people that may not know who you are, maybe they're new to the kind of the financial space, I would love to kind of get to know you a little bit more and just kind of your background, how you are able to now be. I swear, when I was doing some Google searches on you, there's one article and the heading was "You're the king of ETFs." I don't know if you know about this, but that's quite the nice title. So where did you start? How did you get to this point in your career?
Sure. So go back. I'm an immigrant to the country, but kind of had really strong ambition in my life to make a mark, and went into engineering as an undergrad, and then decided I didn't want to be an engineer, and originally actually wanted to be an architect, and and that principally it does come back to some of the things I've done in my career, but I love the idea of building and creating. Innovation and driving change. And so that's where I think a large part of that desire for architecture came from.
Mm-hmm.
What I did out of post university was I joined an investment banking dealer, RBC, and really started to drive an awareness and a knowledge towards financial services as a whole. And got to know the financial services industry very intimately, the asset management industry quite well from my client base. And then just got that itch. I was 28 years old and sort of said to myself that, I didn't want to be a banker for life. And so decided, okay, well, what do I want to do? And one idea came to me that let's go build an investment company. And I'd never run a business before, but I had really interesting vantage point. I had covered a number of the largest asset management companies in the world and got to know the space intimately in the mid-2000s. And I also had covered Barclays, which ran the iShares, or back then in Canada, the iUnits business. So, the one of the first ETF players, and kind of really saw the trends towards indexing and ETFs in general, and kind of got a little excited about the opportunity. And so I started my first company, Claymore, and kind of jumped out on my own and built this thing. And it didn't, I guess it had a lot of history, but thought, I think there's a better way to do this. And so what led to kind of the business plan on it was around the time that I decided to leave. I was really struggling with, as much as I love the principles of indexing and ETFs, what I was struggling with was, I didn't like the way the market cap indexes were created. And so I was really kind of the view that there's some principles here that are important, but I don't like the model. And I came across a wonderful research report in 2004 written by an unbelievably important person to me. At the time, I didn't know it, but became a strong friend and mentor, a gentleman named Rob Arnott. And he built it basically on this idea of non-market cap weighted fundamental indexing. And it was an idea that he built a research report around from an academic perspective. So I honestly read this report as a geeky engineer and said, this is it. And I picked up a phone, I called Rob cold and flew down to Pasadena. At the time, I didn't really appreciate it, but Rob was a pretty big thing. Flew down to Pasadena and the rest is history. Came out of that day with real clarity on the future of investing and the future state of how to build an investment company. And I started my first company that way.
Wow. That's pretty impressive. I know you just said it in a very here's a summary of kind of how that all started, but I'm like, that's not many people could just and then I just started an investment company, no big deal. And it was one of the first ETF companies, and then you eventually sold that company to Blackrock. Is that correct?
That's right. So Claymore was, it wasn't as easy as I just outlined it, but building it in the end was a really wonderful success. We again, you don't think about these things when you start a business, but we help change an industry quite meaningfully. And I think we're seeing today more than ever the effects of the change that we created. But ultimately, after a number of years, so we grew to about $8 billion in assets in 7 years, so the fastest history. And then I had a partner in the business, a financial partner, and after a number of years of just discussions, it just made sense they wanted to get liquidity, and it made sense to sell it. And it was hard for me because I built my baby and was really passionate. And to me, I wouldn't. If you Googled me, I wouldn't say I was Mr. ETF. I would say I was Mr. Claymore more than anything else. That's what my identity was. And so it was a hard thing to sell. But what I learned through that process was a really important education about when you do something really special and you're smart and you can kind of build great credibility, you can go back and do it again. And that's what build my new company, Purpose.
When did you start Purpose, and what was your what did you want to do differently with this new company?
So it's a really great question. So I started it close to about a year after the sale, and you can probably guess why that happened. But I took the year off to kind of really stop and think. And but one of the things that when I decided to do this, I have a strong sense that you shouldn't just go do something and kind of slightly iterate around it. You got to go out and say, can you really make a big difference? Can you kind of what Google likes to term, can you 10x something? And in our industry, 10xing is really hard, but I felt that we needed to do something meaningfully because I'd already built Claymore, and I could that company would now existed, and it's now owned actually by such an impressive organization, it's Blackrock. And so I had to do something that was really even more impressive. So the big thing that I learned through the years, as much as I kind of use that example of meeting Rob Arnaud and kind of thinking about indexing. When I started naively my first company, I assumed the role of an investment company was go out and beat the markets, build investment products that could beat the markets. And so I did. And I said, okay, how do you best beat the markets? Well, if you do the mathematics on it, you come up with a strategy that is disciplined, takes the best of active and passive together, and has an attractive low cost fee against it. And by doing those things married together, you can, over time, slowly migrate towards the top quartile and top decile performance versus benchmarks. And we did that at Claymore. It was really powerful. But, when I realized we went through, my business straddled the 2008, 2009 financial crisis. And as much as, our funds were some of the really great performing funds over 5 years and 7 years, we went down with the markets in 2008 and 9, the same as the market. So if the market was down, 35%, we were down 33%. And, some money managers would argue that, hey, we beat the market. But in my opinion, we made clients really uncomfortable. We had people selling at the wrong time emotionally, buying at the wrong time emotionally. And what I realized was I didn't really do anything important for the end customer. I created a product, but I didn't really help the customer meet their long-term goal. And so I said, if I'm going to do this again, I'm going to focus on helping meet liabilities and acting and thinking more like how a pension plan thinks, which is let's help people build better long-term portfolios, focusing on risk management, focusing on, yes, returns, but really helping people focus on what it is they're really investing for, which is they're trying to invest to meet some goals, some liability, some outcome. I think that as money managers and manufacturers of mutual funds and ETFs, we have an obligation to think this way and help advisors and investors, kind of build better portfolios. And that's what we've been doing at Purpose. But at the same time, to do that with the same kind of core fundamental belief system we had before, which is have really strong, disciplined investment strategies, keep costs low, and at the same time, be extremely transparent with our customer base. And so we've done that, and it's been an amazing experience in building this again over the last 5 years.
Yeah, absolutely. So I would love to get your thoughts, because you kind of talked about how you don't necessarily believe in or subscribe by the idea of indexing, which seems to be kind of becoming more popular, which I'm a big fan of, just because it's a big leap from people doing actively managed mutual funds, paying really high fees, still not really having a clear idea of what they're investing in. So with all these kind of robo-advisors or more information about how to actually buy ETFs yourself through a discount brokerage so people can kind of become DIY investors, what are your kind of thoughts on just this trend? It feels like it could just because I'm in a bit of a bubble, but I feel like more and more people are kind of understanding a little bit more about investing and specifically like this index strategy. And what were your kind of thoughts on that?
So first and foremost, please don't get me wrong. Like I love what the principles of what indexing have done for the consumer and for investors. And I have built a large part of my thesis on the same principles. And what makes something really powerful is the fact that they have some discipline around their investment process, and so set of rules, and so they don't let emotions of investment management kind of dictate. They're diversified. But also that they keep their costs really low, and that you touched upon that point, which is against high cost mutual funds, against high cost advice models and things like that. Most investors, the odds are stacked against them, unfortunately. No question, optimizing and reducing fees is a very important thing. That said, though, I also believe that we need to step back for a moment and have some perspective, and so. One of the things, so just as a side point, you may not know it, but I co-founded a firm called Wealthsimple. So I really do believe in build strong, diversified portfolios.
I don't think I knew that you co-founded Wealthsimple.
So I did that with a gentleman named Michael Katchen, and believed in the vision of how do you create an unbelievably important kind of service for consumers who want to both start investing, but also long-term want to be engaged in the markets, but don't need necessarily a full, heavy, advice hand. So, I think advice is extremely important. And one of the things that I've always believed is that do-it-yourself investors actually oftentimes struggle to do it. And so having a guided portfolio strategy, whether it's with a full-service advisor or with a robo, is actually something that's really important. And so we built that business on that basis. But so I really fundamentally believe in this, and costs are important to all of those models. But I also believe that you have to have the perspective of time. And so then what I mean by that, the last 35 years in investing have been an unbelievably lucrative period for investors. And it has also been a very, and that's driven because as many people may know, but many younger people may not, is that interest rates in the 1980s were in the high teens and have precipitously come down to, at some points close to zero, as you know, and have slowly been started creeping up. But effectively, we have some of the lowest interest rates in history of hundreds of years today. And so that period of the last 35 years has benefited from an amazing declining interest rate environment, which has sort of helped self-correct all different types of risks and market corrections and things like that. Whenever we've had a bad time, markets kind of, interest rates helped get people back on the same page because interest rates got cut and equity markets went back up, post 2000, post 2000, all the rest of it. And so for that reason, indexing and optimization of fees has been the best and most optimal way to invest in that trailing environment. Problem is that when you look at a time today going forward, our view is that investing is going to become more difficult. And what I mean by that is the beta markets, the long indexing is actually going to start to really challenge, because when I look at first indexing in bonds, fixed income, fixed income is one of the most difficult and challenging parts of the market today. And I think that most people are going to really have, unfortunately, low and bad returns from fixed income over the next 5 to 10 years. Mainly because of interest rates being so low and also the risk of bonds relative to the return not being attractive. And then on the other side, on equities, although equities generally over the long period do perform well, we are at a time when equity returns are at the tail end of one of the great bull markets. 9-year bull market, we're in our 10th year. And, I'm a reversionist, and I believe that future returns are going to be dictated by historical returns. And so therefore, if you believe that if we're coming off one of the great historical returns of equities, my future expected return in equities for the next 10 plus years are likely going to be dampened. And so marry those two together in a balanced portfolio, what most people would think is like a 60-40 portfolio or a balanced portfolio, most people's returns over the next 10 years could be quite depressing. And so, yes, optimizing for fees and all the rest is great, but it still isn't going to get most people to the return that they need. So I just think that investors need to have the discipline of thinking like an index investor and focus on caring about costs around the fringe, but also focusing on strategy and outcome more than anything else.
Okay, so what if someone? So you're kind of warning against some possible things that could happen if you do follow the indexing. What should people do, I guess, to kind of counter this? How can they kind of maybe protect their investments?
Well, first and foremost, I think I think it all comes down to when you say protect investments. I think it's more about structuring properly. For any investor who's not in the stage of at retirement or really, really close to retirement, your number one focus right now should be in accumulating wealth through savings. And so what does that mean? From the day you get your first paycheck, or if you haven't already, start with your next paycheck, is creating a systematic savings program from your paycheck to a savings and investment account. You should do that, as regularly as every paycheck, and if you can, even more. The younger you are, you should be trying to save 15 to 20% of your paycheck. If you start later, you should be saving more, unfortunately. And so that's a very simple, basic thing. The second then you should do is then with the money, what do you do? Well, that's when you go, you work with either a online wealth advisor, like a robo platform like Wealthsimple or other, or you go to a advisor if you have a large enough sum that you can start with an advisor, that is a full service advisor, or if you have the confidence, you can start on your own and build your own portfolio. And in building that portfolio, what you want to focus on is, again, cost, make sure that you've got an attractive fee. And what I mean by that is you don't want to be paying 2.5%, 3%. Anything that's in the sort of 1% or less is quite attractive. And range bound, that's sort of what you should kind of generally expect. And then the second thing is you should be focusing on portfolio construction. And so just like any other thing, you want to buy fundamentally good assets. So if you buy ETFs, understand what the underlying strategy does, how it invests the money. For example, don't just aimlessly buy an index because it's cheap. Go and understand, hey, if I put $1 into this, what does that dollar actually invest into, and how does it invest? And would I, if I was running the same thing myself, invest the same way? Ask yourself those questions. And I know it's a bit of work, but again, this is your money. You should care. And so my view is that you want to pay attention to these things and understand it. And my thesis today is that, as I said, I think that a passive portfolio in its most simplest form will actually have some challenges ahead. But I think you can get very close to the same concept of investing in really strong investment products, low cost, but kind of adding in some thinking around fundamentals or active thinking around fixed income specifically to help kind of navigate some of the risks that you'd normally see in the index world right now.
I recently read an article. You were featured in the Globe and Mail, and you were kind of talking about this idea that you believe eventually in the future ETFs may become obsolete. A lot of this had to do with kind of the popularity of cryptocurrency and just, we don't even know what's going to happen in the future with cryptocurrency. Do you want to speak a little bit about that and what your kind of thoughts on that are? I think that's very interesting, very like future thinking.
Yeah, well, I mean, I get, I think that was somewhat misquoted.
Oh yeah, probably. It was a very good clickbaity title, I'll tell you.
A ton of attention. So let me kind of step back and explain what I think is the way I think. I'm a forward-thinking person. I always am a big thinker. I try to envision the future state of any business, of any markets. And as I talk about these issues, I think about, the 5-year forward problems, not the what does the last 10 years look like, because that already happened, right?
Mm-hmm.
So, one of the things that when I started Purpose, I've been always pushing my team on is, what are the technologies and what are the innovations that are going to make ETFs obsolete, or are you going to improve upon the work that ETFs have done against mutual funds, for example? And so, as you know, or maybe some of your listeners know, ETFs were created not by mutual fund companies. Traditional mutual fund companies in the 1990s, the Fidelities of the world, and the Franklin Templetons, and in Canada the CIs, and the big players. They were happy and fat, managing big active mutual funds with big management fees. And a bunch of outsiders, players like Barclays and State Street and Wisdom Tree and, my company, Claymore, these are the firms that on the outside looked in and said, hey, we can come up with a better model. And they created the ETF structure. And today, the ETFs, of course, are an optimal model for investors and are being utilized by, all types of investors, institutions, retail, everybody. And it's been amazing. And now, call it 30 years on, the mutual fund companies have started to act more and launch ETFs and recognize the structural advantage and use them. So, it's great, but it wasn't invented by the incumbent. My argument has always been to say, for that same reason, as an ETF company today ourselves, whatever is going to be ETF 3.0, the next iteration, the thing that's going to kind of make our product even better, is not likely going to be invented by ETF companies. It's going to be invented by outsiders, people who are looking in and saying, I can do that better. But as an innovator, I've always sort of said, we need to be thinking about this, and we need to be the ones who are open-minded to the fact that, we may not have the best optimal model long-term. And so I've been stressing this to my team. And so, we constantly are in search of that kind of vehicle or that structure that's going to help. And we have ideas of what that is in the future and all the rest of it. But that's how we, as a firm, stay on top of our toes and as opposed to back on our heels. One of the areas that I've been, call it, curious about, and I started to, just like most people, 2 years ago, when I heard the word Bitcoin and cryptocurrency, I was, very passive on it. I'd kind of dismiss it. I'd say that this is just some kind of fad or scam or whatever it be. But, when I actually started to, recognize that I actually knew very little about it, but I started to do some research on it, and I started to get fascinated about the technology behind it. You've probably heard about, of course, what now we know is blockchain and blockchain technology. And I actually started to recognize that there's some really amazing, profound elements to that technology. And so, I kind of pushed my team to step back and say, guys, there's something here that could be interesting, but it's still years and years and years away. But the idea of it could have a profound impact on some of the principles of how money management could be changed. And I'm not talking about cryptocurrency stuff and managing cryptocurrency. That's not what I'm talking about. I'm talking about the settlement and technology of blockchain that allows you to effectively run, products and potentially manage money even cheaper than we do today, which is very, very unique, again, to help reduce the cost to clients. And so we started to pay a lot more attention to it. In the last year, we became even more curious about it. We made some investments ourselves into certain areas and technology players. And then, about 9 months ago, we made a decision that we needed other people we felt that everyone should have a seat at this table. And so we actually created a vehicle called Ether Capital that we assembled a really profound and amazing group of partners to partner with us on, to really go out and give people in the public an access point to what we think is the blockchain technology opportunity over the next 5 to 10 years. And we created Ether Capital as a very unique startup technology company, and it trades on the exchange in Canada, and it's the first pure play Ethereum based vehicle in the world. So very unique concept, and but to that point, we think that there's going to be many different iterative technologies out there that could be disruptive to management, to ETFs, and to help investors even do better. And, as a firm, we're focused on how do we help drive that change and lead that change as opposed to always being, kind of waiting for somebody else to do it.
Yeah. Sounds like some exciting things, scary/exciting things in the future. And I think kind of like the big message I'm kind of feeling from our conversation is it's important to, of course, know what's going on right now, but I guess keep informed. Like investing isn't one of those things that you know it all and then you could just live your life. You kind of have to continue to kind of inform yourself because these new things keep popping up. It's incredible just how much has changed in the past 10 years in terms of investing. Lots of the investing books out there kind of, you can't use them to, as a guidebook anymore. You have to kind of do your own research these days.
I disagree with a couple things there. Only I don't want to make anybody feel like it's scary and all the rest of it. I actually avoid that. What I would say is this: look, there's a couple of core principles that are really important. So first is that investing isn't hard. It's you need to kind of set a set of rules for yourself. And what I mean by that is, what is it you want to be as an investor? So, great example. If I'm 25 years old and I'm a professional, maybe I'm a lawyer, over the next 30, 50 years of my career, I'm going to make my money not by investing, but I'm going to make my money by being a great lawyer. I'm going to be, my career, I'm investing in my career is going to basically help me increase my salary, my income, and then my savings rate. And then, more and more of my savings is going to go into the markets and I'm going to compound that. The kind of lack of perception there is that most people think that they get rich by investing, and what actually it is, you get rich by kind of having a discipline around saving and investing in your career and yourself and your opportunity of increasing your kind of long-term incentive and constant compensation and opportunity that way, and then having more of a savings. What investing does is augment all that. And then having a set of rules around how you kind of invest is very important. So, one of the biggest risks in investing is not the markets per se. It's actually you and me as individuals. We are emotional and we make bad decisions. We chase trends. We get emotional when things are, going down. We listen to our friends at the golf course. We get caught up in, insecurities and regret. When we buy a stock at $100 and it goes down to $50, we think that, I'll wait till it goes back to 100 before I sell it. And oftentimes that never happens. And so, there's a lot of biases in that. And so one of the things about having a discipline about investing is that it can help you avoid your human cognitive biases and stick to a set of rules. And that's what, by the way, indexing and advice help you do is avoid those emotions. But the other part of it is that, investing is not something that is new, meaning there are like when I talked about, for example, the last 35 years being different, very exciting for investors and making people, really great lucrative returns. When I go back 100 years, returns also have been very strong and lucrative for investors. But there's also been many periods where it's been challenging and they go through stretches and, and they're different types of experiences. But the core principles of how to make money, 100 years ago, 50 years ago, and 30 years ago, ultimately remain the same, which is buy, strong fundamental assets that perform well, keep your costs low, and build a diversified portfolio. And, this is the kind of things that, when you talk about reading important books and stuff, I actually believe that every investor should read, Benjamin Graham's books, understand these types of principles because, those are the types of things that help you actually understand what investing is all about and how to make money and, why you do it. And then the rest of it is actually how you decide to execute on it, whether you buy ETFs or you buy active money management, or you find an advisor to do asset management for you or whatever it be. And I think it's all about the discipline, the rules, and the fact that you're doing it that matters more than anything else. And then the rest is how do you construct your portfolio and how do you achieve your long-term goals.
Absolutely. And just experience and and taking the plunge. I think, especially when it comes to young people, young investors, even if they have lots of this information in their mind now, it's hard kind of just taking that first step. But like you said, it's important to start young. That's the best time to start. So you have to just do it.
Do it, exactly. And actually, you're right. I mean, the hardest is the first step, but once you get into a routine and you actually set up your savings account structure so that it basically deposits from your check. And I always say the first job you get, you should start doing it in your first paycheck. And then if you haven't started already, do it on your next paycheck and just start it. And start with something that you think you can manage, and then just keep pushing yourself to save more and more. And a 20-year-old starting should always be at the sort of long-term savings rate of about 15% of their check. And as time goes on, that will increase the later you start. So, if you start at 22, you should be at 15% for your whole life. If you start at 30, you should be probably in the 25% range for the rest of your life. I mean, and that's the unfortunate thing of just missing compounding for a long period of your life.
Absolutely. Absolutely. Well, I feel like I could talk to you for another hour, Som, but I'm not going to do that to you. I appreciate you taking the time to chat with me and sharing your wisdom. I know a lot of people are going to get a lot out of this episode. You are a wealth of knowledge. I'm excited to see, where Purpose Investments and your new venture, Ether Capital, will be in the future. Thanks so much.
Thank you for your time, and it's always a pleasure.
And that was episode 176 of the Mo Money Podcast with Som Seif from Purpose Investments. You can find out more information about him and his company at purposeinvest.com. And of course, you can check out the show notes to learn more about the topics that we talked about in this episode at jessicamorehouse.com/176. And make sure to come and check out my website, jessicamorehouse.com. A lot of great stuff on there. I've got a blog, guys. So in case you want to read instead of listen, I got lots of great info on the blog, share videos, and a lot of news and information. Speaking of, I'm always doing new things, which is why I have such a hoarse voice, because I've been working myself too hard. But if you want to be in the know of all the things that I'm up to, or, contests I'm doing, or events I'm doing, or all that stuff, make sure to get on my email list at jessicamorehouse.com/subscribe. You will not regret it. Okay, I've got a few important things to share, so please do not go away. Here's just a few words about this episode's sponsor. This episode of the Mo Money Podcast is supported by CoPower Green Bonds. What's in your investment portfolio? Like, seriously, what kind of companies are you investing in? You may be surprised and, not exactly thrilled to see that you're investing in companies that don't actually align with your personal values. Here's one way you can change that. CoPower Green Bonds, a way to invest your money to fund renewable energy and energy efficiency projects in Canada. CoPower was founded in 2013 with a single mission: to unlock capital for climate solutions by empowering Canadians to participate in and profit from the transition to a low-carbon economy. If you're just as concerned about climate change as I am, this is one way you can do something actively about it, while also earning high returns for your financial goals. I'm talking 4 or 5% on your investment. Want to learn more and get started? Then visit greenbonds.ca. Once again, that's greenbonds.ca. Okay, so first things first, very important. This week, my Canadian friends, is known as Credit Education Week. So Credit Education Week runs from November 13th to 16th. And basically, it is just a way to kind of promote financial literacy awareness, but specifically with the topics of, credit management, debt management, all that kind of stuff. And every year there's a new theme. This theme is money mindfulness, which I love. Just a friendly reminder, we all need to not just be better at money, we need to be more mindful with our money. We need to be more conscious consumers. So if you're finding that you're having some trouble with your finances, you're, always over shopping, overspending, all that kind of stuff, take a minute, think about it. Be more mindful. Do you need this? Is this something that you need? Is this just a want? Is this something you can afford? Is it not something you can afford? And then if it's not something you need, if it's not something that you can afford, put that debit or credit card back in your wallet and just walk away. Just walk away. Or go to cewc.ca for some more information about Credit Education Week. I think you'll get a lot of info from it. There's also lots of free events happening this week. So all that information is on that website. But since I also mentioned Financial Literacy Month, that is also, this is why November is my favorite month, Financial Literacy Month. There's some great things going on this month, a lot of great tools that are kind of being launched or promoted more. So this is really a great time to really hunker down and look at your financial life and see how you can improve it. We're gearing up for, December, which is like prime spending time. And then we're back into a new year, January, and why not start working on improving your life before New Year instead of just setting those goals, as New Year's resolutions? Why not start working on it now? And one place that you can find some more information about a Financial Literacy Month, and in case you're wondering, I guess kind of the theme for Financial Literacy Month this year is invest in your financial well-being, which I love. So there's a lot of great information on the Government of Canada's website, actually. So if you go canada.ca, it's a really long URL. So if you just Google Financial Literacy Month, honestly, that'd probably be easier. But you can find a lot of great info about Financial Literacy Month on there. Also, I want to share that the Millennial Money Meetup that I've kind of been talking about for the past couple of weeks, that's going to go down on November 27th in Toronto. It is officially sold out. Sorry, guys. So if you didn't grab your tickets, you can still register to get on the waiting list because some people can't make it. So I can release their tickets to you. So that's always something you may want to check out. Just go to millennialmoneymeetup.com for more information on that. But what's really exciting is Fisco is kind of the sponsor for that event, the Financial Services Commission of Ontario. And they just launched a new kind of part of their site all about retirement planning, which I think is amazing. Because, especially as younger people, we don't even know where to start. We don't know lots of the questions to ask because retirement is so far into the future. So if you go to Fisco, fsco.gov.on.ca/retirement. There's really great information on their website about retirement planning, pensions, and just setting yourself up early for that kind of financial success in the future. So I know you're going to love it. All right, that is it from me because I can't speak anymore. My voice is going. It's going. But I'm going to see you back here next Wednesday with a fresh new episode. Can't wait. And if you would be so kind just to take 2 little baby seconds to give me an iTunes review. I've got a couple that I've been saving to do some shout outs for next episode. So if you want to get those in and get a shout out from me next week, well, please spend 2 seconds and give me an iTunes review. Let me know what you're thinking about the show. Would really appreciate it. All right. Thank you so much for listening. I will see you back here next Wednesday.